Capital gains for beginners. Alright, so capital gains affects any investor who makes profit. In the video, I'm going to go over what capital gains are, how much they actually cost to your profit, as well as how to negate these capital gains. So let's get to it. What are capital gains? So every time you buy a security and you sell it for more, that is a realized gains. It's once you sell for a profit. And realized gains are taxed at capital gains tax rate. And there's two. So there's short-term capital gains and there's long-term capital gains. Short-term capital gains are taxed at your income tax bracket, and long-term capital gains are for realized gains longer than a year, and it's taxed at 15%. Those are capital gains, and so short-term gains are securities that are made profit under a year, and these can be really costly, especially if you are in the 25% income tax bracket. I'm going to show the cost. Okay, so here's an example. Let's take two accounts worth $10,000 and they both make interest of 10%. So the first account is not going to realize their gains and therefore won't be taxed at capital gains, but the second account is going to realize their long-term gains and then be taxed at capital gains tax rate of 15%. So after a year, the first $10,000 account makes 10%. So now the new account is worth $11,000. The second account also makes 10% and is worth $11,000, but those are gains that are realized, and so therefore they're taxed at capital gains tax rate. So now the account is going to be taxed $150, which is 15% of the gain of $1,000, and now the account is only worth $10,850. Now the next year comes and the first account earns 10%. The first account is now worth $12,100. The second account also earns 10%, but this account only makes $1,080 on their return. So now the second account value is only worth $11,935, and it has to be taxed at capital gains tax rate. And that's going to take away $162 off of their earnings, and so now their account value is only going to be worth around $11,780. Okay, and this is the issue with capital gains, is that when you realize gains, they take away from your profits, and those profits don't earn the 10%. And if you don't realize your capital gains, well then your full profits are earning 10% for you. So this is why capital gains can cost a lot to your profits, because by taking away some of your profits, those profits aren't reinvested, and so you don't make as much. Now, how can we negate these capital gains? The first one is only taking short-term realized gains if you are under the 25% tax bracket. So either being taxed at 15%, 10%, or 0%. This is the only time this is the most efficient time to realize short-term gains. The second thing you can do is just to only realize long-term gains, and will be only at 15%. And this will still reduce your profits, which reduces your overall gain after reinvesting profits, but it's the second best thing you can do. Now the best thing you can do is only realize gains after a long period of time. And this is why Warren Buffett holds his shares forever, because the longer he holds his shares, the more profit can be reinvested, and with the more profit that's reinvested, the more interest is on those profits. One of the other ways you can offset capital gains is by taking capital losses. So if you have a capital gains of 10% and you also have capital losses of 5%, you can subtract that 5% from your total capital gains to put you at 5%, and now only 5% of your gains are taxed at capital gains tax rate. So that was really simple for capital gains. Of course, you will have to worry about it once you start making higher income, and it's good to be aware of it as a beginner. So if you liked the video, hit the like button and also subscribe, because I post early in the morning when the stock market opens or after the stock market closes. I do videos on stock education. I'm planning to do videos on financial, and I'm also looking to do more analysis on more companies, so look out for those.